Hi, good morning. My name is Nicole, and our group will be discussing differential analysis and product pricing. Now to start, let us quickly define the common terminologies that are used in this chapter. So differential revenue is the amount of increase or decrease in revenue that is expected from a course of action compared to an alternative, while differential cost is the amount of increase or decrease in cost that is expected from a course of action as compared to an alternative. And the difference between these two, the differential revenue and the differential cost, is called differential income or loss. So differential income would indicate that the decision or the alternative will have an increase in income, while differential loss will define that there will be a decrease in income if a certain alternative will be chosen. So overall, differential analysis is used in order for managers to come up with a decision and decide whether to push through with alternative 1 or alternative 2. And in order to come up with that decision, we're going to discuss the steps and the objectives on how to have the correct facts on deciding which would be the best alternative course of action. So to illustrate, here is an example from Bryant Restaurants Incorporated. So let's assume that Bryant Restaurants is deciding whether to replace some of its customer seating or tables with a salad bar. So in this table here, we'll see the information or the facts that we currently have. So we have alternative 1 for the tables, we have alternative 2 for the salad bar, and you can see the revenues for choosing alternative 1, costs for choosing alternative 1, and the same for alternative 2. Now, if you have this data as a manager, what is the best alternative course of action? So before a manager decides the best alternative course of action, these are the following steps that are involved in the decision making. So step 1 is to identify the objective of the decision. So most of the time, the objective is to maximize revenue. And then step 2 is to identify alternative courses of action, in which we have here an alternative 1 and alternative 2. Step 3 is to gather information and perform a differential analysis. So in this table, we have the first column for the alternative 1, second column alternative 2, and the third column will be for the differential effect on income. So in order to get the differential effect on income, we can deduct alternative 2 from alternative 1. So we have 120,000 minus 100,000. That will be our differential revenue of 20,000. So any positive amounts will be an indication that it is an increase in income. While for the costs, we have 65,000 minus 60,000. So we have an increase in costs. So that will mean it will be a decrease in income. So it will be in a negative 5,000. So the differential income will be determined by deducting the differential cost from the differential revenue, which is the differential income will be 15,000. So in this case, since it is a positive amount, that means that alternative 2 would be the best alternative course of action because it will generate a higher revenue compared to alternative 1. So that means that will be our step 4, making a decision. So you can make a decision once you have your differential effect on income based on alternative 1 and alternative 2. Now step 5 is just to review, analyze, and assess the results of the decision. So it can be done by comparing the actual revenues and costs compared to this initial table that we have here. And if there is a huge difference in the amount, there might be another differential analysis that should be created in order to again decide if alternative 1 or alternative 2 would be the best course of action. So in this chapter, there are also common decisions that differential analysis can be illustrated. So one would be lease or sell. So this happens when a company changes its manufacturing process or they can no longer use the equipment in their process, and so they have to decide whether to lease or sell a piece of equipment. So as an example, here is an illustration from Marcus Company. So assume that on June 22 of the current year, Marcus Company is considering leasing or disposing of the following equipment. So in this initial data here, we have the cost of equipment of 200,000. We have the depreciation amount of 120,000, and we have two alternatives, which will be to lease or to sell. So alternative 1 shows 160,000 of total revenue if they are going to lease the equipment, and we have 35,000 on the costs for expenses on repair, insurance, and property tax. While on alternative 2, we can sell it for 100,000 minus cost for the commission on sales, which would be 6,000. So in this table here, this will show you the differential analysis on alternative 1 and alternative 2 based on these data. So in alternative 1, we have the lease the equipment, and alternative 2 is sell the equipment. In order to get the differential effect on income, we can deduct 100,000 alternative 2 from alternative 1. So that will give us a decrease in revenue of 60,000. And for the costs, we can deduct 6,000 from 35,000, and so that will be 29,000 in the differential cost. So in order to get the differential income or loss, we deduct differential costs from differential revenues, which is 31,000. So that means there is a differential loss if we are going to sell the equipment instead of leasing the equipment. So in here, step 4, making a decision, it should be to lease the equipment. So you'll have 125,000 in income compared to alternative 2 of 94,000 in income when you sell the equipment. So another common decision that differential analysis can illustrate is whether to make or buy. So in this illustration, assume that an automobile manufacturer has been purchasing instrument panels for $240 a unit. So if they're currently purchasing it for $240, this is the cost if they are going to manufacture the instrument panel internally. So for the direct materials, direct labor, factory overhead, and the fixed factory overhead, the total cost per unit is $280 compared to the $240 a unit. So in this simple illustration, if a manager has to decide, it will be simply to keep on purchasing the instrument panel instead of manufacturing it for $280. However, it is stated in here that the factory is currently operating at 80% of capacity only. So if they're going to manufacture their own instrument panel, there's still 20% of capacity in which the fixed factory overhead will not be affected. So we can see in this differential analysis, alternative 1 is to make panels and alternative 2 is to buy the panels. So as mentioned, if we are going to purchase the instrument panel, it will be for $240, and we have to keep the fixed factory overhead of $68. The reason why we have the $68 in here is because the fixed factory overhead cannot be eliminated by purchasing the panels, especially when the factory is only operating at 80% of capacity. So in alternative 1, if you're going to make the panels, we have the direct materials, the direct labor, the variable factory overhead, and also the fixed factory overhead. So that will be a total of 280 compared to the total of 308 in buying the panels caused by the fixed factory overhead. So the differential effect on income, if we're going to deduct 308 from 280, we are going to get a differential loss of 28, which means alternative 1 would be the best alternative course of action compared to buying the panels, because the costs for alternative 1 is 280 while the cost for buying the panels is 308. Here are some exercises from the related topics discussed on the previous slides. So exercise 9-2, differential analysis for a lease or buy decision. We are required to prepare a differential analysis dated August 4 to determine whether car should lease or purchase the equipment. Car Corporation is considering new equipment. The equipment can be purchased from an overseas supplier for $3,900. Freight and installation costs are $515. Annual repairs and maintenance are $410 per year over the 4-year useful life. Alternatively, car can lease the equipment from a domestic supplier for $1,750 for 4 years with no additional costs. So in this table, we identified alternative 1, lease equipment, and alternative 2 is buy the equipment. So for the buy the equipment, the variables mentioned earlier were $3,900 for the purchase price, $515 for freight and installation costs, and repair and maintenance would be $410 times 4 years, so that's $1,640, and the total income or loss would be $6,055. While for alternative 1, the the lease amount for the equipment is $1,750 per year for 4 years, so that's $1,750 times 4 would be $7,000. Now, as discussed earlier, the differential effect on income can be determined by deducting alternative 2 from alternative 1. So in this case, all these costs, purchase price, freight and installation, repair and maintenance, this will be in a negative amount for alternative 2, while the lease for 4 years would cost $7,000 if the approach would be to lease the equipment. So in order to get the differential income or loss, we would calculate 3,115 and 1,640 from 7,000, which would be 945. So that means if we're going to consider alternative 1 and alternative 2, there is a positive amount on the differential effect on income, which means that alternative 2 would be the best alternative course of action, since the cost would be $6,055 compared to the $7,000 cost if you're going to lease the equipment. So considering that there were different costs related to buying the equipment, it would still be a lesser cost compared to the purchase price compared to the leasing price of the equipment. Exercise 9-4, differential analysis for a discontinued product. So in here, we are required to prepare a differential analysis dated March 31 to determine if cups should be continued or discontinued, and letter B, should the cups line be retained. So the condensed product line income statement for Dish and Dat Company for the month of March is as follows. We have the income statement here with the bowls, plates, and cups, and then sales, cost of goods sold, gross profit, selling and admin expenses, and then income from operations. So in this table is a differential analysis whether to continue the cups or discontinue the cups. So we are now considering this column, the cups. For revenues, if we're going to continue the cups, it is at $31,300, and then for the variable cost of goods sold, it's negative $14,280. So in order to obtain that, based on the problem, fixed costs are 15% of the cost of goods sold. So that means cost of goods sold is $16,800, and then the formula is $16,800 times 1 minus 15%, which would be 85%. So that is $14,280. So same with the variable selling and admin expenses. As mentioned in the problem, it is 40%. Fixed costs are 40% of the selling and admin expenses. So that is calculated by selling and admin expenses, which is $16,700 times 1 minus 40%. So it's $10,020. And then for the fixed cost, it is calculated by 16,800 times 15% or 0.15 plus the 16,700 selling and admin expenses and the 40% fixed cost from the selling and admin expenses. So that would be 9,200. And if we're going to add this all up, the income or loss is at $2,200. And for discontinuing cups, fixed costs will not be affected because it will be the same for continuing or discontinuing, because fixed costs are not specific into one product or service only. So in order to get the differential effect on income from alternative 2 and alternative 1, we are going to deduct alternative 2 from alternative 1. So in this case, if you're going to discontinue the cups, the differential effect on income will be a negative 31,300. And for the variable cost of goods sold and selling and admin expenses, since alternative 2 will be discontinuing the cups, it will be in a positive amount, 14,280 and 10,020. So for the fixed costs, it was mentioned in the problem that this and that assumes that fixed costs would not be materially affected if the cups line were discontinued. So in order to get the differential income or loss, we will be calculating this by 31,300, 14,280, and 10,020. And we got negative 7,000, so that is a differential loss of 7,000, which means that the cups line should be retained. That's the answer for letter B, because the difference on the loss of 2,200 compared to discontinuing the cups and a loss of 9,200, it is advisable to continue the cups instead of discontinuing it. So for the answer in letter B, cups line should be retained. Income will decrease by 7,000 if the cups line is discontinued. This is explained as with the fixed costs, whether a certain product or service is continued or discontinued, it doesn't really affect, or it doesn't eliminate the fixed cost. That's why it's not always the best decision to discontinue a product if there are other factors that needs to be considered, like what would be the total cost or loss of a product if it's going to be continued or discontinued.
Exercise 9-7, make or buy decision. So in this, we are required to prepare a differential analysis to determine whether the company should make or buy the carrying case. Jupiter Computer Company has been purchasing carrying cases at a purchase price of $70 per unit. The company is currently operating at below full capacity and charges factory overhead to production at the rate of 40% of direct labor cost. If they are going to produce the carrying cases, here are the unit costs. So for the direct materials, they have $45, direct labor at $20, and factory overhead at $8 as per 40% of direct labor. So here is the differential analysis for alternative 1, make carrying case, and alternative 2, buy the carrying case. So for making the carrying case, we will consider the following variables given in the problem. So we have direct materials at a cost of $45, direct labor at $20, and variable factory overhead per unit, that's 20 times 15%. So in the problem, it was mentioned that the cases are expected to be 15% of the direct labor cost. So that's 3, and then the fixed factory overhead per unit is at 5, calculated by factory overhead minus the variable factory overhead per unit. So the total cost in making the carrying case is $73. As to buying the carrying case, we have the purchase price of $70 per unit. So we have $70 per unit, and the fixed factory overhead, which was mentioned in the previous slides, where it would not affect whether we continue, discontinue, make, or buy a product, since fixed factory overhead is not calculated or specific to a single product or service. So we have $5, and if we add 70 with 75, that will be 70 and 5, that will be $75. So for the differential effect on income, if you're going to calculate the difference between buying and making, will have a cost of $70 if we're going to purchase the carrying case, and we're going to eliminate the costs, which is at a positive amount in here, because if we're going to buy the carrying case, we won't be needing these following unit costs to consider. So that's $70, 45, 20, and 3 for the cost in making the carrying case. So we'll have a differential effect on income of $2. And to answer letter B, on the basis of data presented, would it be advisable to make the carrying cases? So as a manager deciding whether to make or buy the carrying case, if we're going to have a differential effect on income at $2, the best alternative decision would be to make the carrying case, as it only has a cost of $73 compared to the cost of $75 if we're going to buy the carrying case. So in this case, just looking at the problem, it's not advisable to buy the carrying case because the purchase price plus the fixed factory overhead will be greater than the cost in making the carrying case by Jupiter Computer Company. Exercise 9-8, make or buy decision for a service company. So in here, we are required to prepare a differential analysis to determine whether Tag D should lay out pages internally or purchase layout services from the outside. So Theater Arts Guild of Dallas, or Tag D, employs 5 people in its publication department, and they lay out pages for pamphlets, brochures, magazines, and other publications for the Tag D productions. Now, the company is considering an outside publication service for the layout work with a price quote of $13 per layout page. If they are going to consider the budget for the year, this is what we have. So we have the salaries, benefits, supplies, office expenses, office depreciation, and computer depreciation. So it was also mentioned in the problem that the publication department office space and equipment would still be used for future admin needs if the department's function were purchased from the outside. So regardless if they make or buy, we are still going to have the cost of office depreciation and computer depreciation, since it was mentioned that it would still be used for future admin needs. So that needs to be considered when creating the differential analysis. So in the differential analysis, we have alternative 1, lay out pages internally, and alternative 2, purchase layout services. So with alternative 1, we will consider the following data for the budget and for the cost if we're going to lay out the pages internally. So for the salaries, the benefits, the supplies, office expenses, depreciation, and computer depreciation. So that's a total cost of $372,000 if Tag D would consider laying out the pages internally. Now, if they would consider the outside service and the outside publication service for the layout work, the purchase price of layout work is $13 per layout page times 24,000 pages. So that's this one, $13 per layout page, and 24,000 pages, which is calculated in here and is equal to $312,000. And as mentioned, for the office depreciation and computer depreciation, regardless if it's going to be internally layout internally or it will be purchased outside of the company, will still have the same amount of $28,000 and $24,000. So that is a total cost of $364,000 if we're going to purchase the layout services. So for the differential effect on income, we have a cost of 312,000 if we are going to purchase it outside, and then that will eliminate the cost of the salaries, benefits, supplies, and office expenses. But for office depreciation and computer depreciation, it will be irrelevant for this computation. So the differential effect on income, or the differential income or loss, would be $8,000. That means the best alternative is to purchase the layout services instead of doing it internally, because we have a cost of $364,000 in purchasing it outside of the company compared to the $372,000 cost if they're going to lay out the pages internally. So I think for this one, it's a difference between the purchase price of the layout work, which is just $312, compared to the salaries and the benefits plus the supplies that you are going to use if it's going to be done internally. So in this case, we can make a decision to purchase the layout services. So that's the answer for letter B. It would be best to purchase from an outside company. So what additional considerations might factor into the decision making? So I think in this case, if they are going to purchase the layout services at this price for that year, it's not a guarantee that it will be the same price in the long run. So the following year, or 2 to 3 years from the current year that they were given this price, this might increase, and so that means it might be required to create another differential analysis if that happens. And also, if other factors to be considered, if it's going to be purchased outside of the company, it won't be the quality of the layouts will not be controlled compared to having it internally, where the entire department and the 5 employees will have total control on the quality and making sure that it is within the company's preferences. And lastly, I believe it's also a factor to consider the timeline of the production. So there are changes that might need to be applied with the layouts that should be communicated to the outside provider, and if it's not within the discussed deadline, it might be an issue compared to doing it internally, where the employees or the entire department can make these changes in the timeline whenever needed. So with the differential analysis, it's always good to see the costs of their alternative 1 and alternative 2, but it's not always black and white case where you'll see the difference in the cost, because sometimes there are other factors that you need to consider in terms of like the entire operations if it's going to be in an actual production process.